A winning stock can make you feel that you were right, while quietly hiding the possibility that your decision was wrong for a completely different reason. That is the uncomfortable paradox of investing. A profitable outcome does not automatically prove that the process was sound, and a losing outcome does not automatically prove that the process was foolish. The market can reward a fragile decision, punish a disciplined one, and make both look identical for a while. So when a stock rises after you buy it, the more important question may not be, how much did I make, but what exactly did this profit prove? Imagine buying a stock because its business appeared strong, its valuation seemed reasonable, and your original thesis made sense. Then the price rises. Naturally, the brain connects the two events. I analyzed it, I bought it, it went up, therefore my analysis worked. But markets contain thousands of variables that exist outside any individual investor's reasoning. Changes in expectations, liquidity, interest rates, sector rotation, earnings surprises, sentiment, positioning, and simply the unpredictable arrival of new information. A correct outcome can therefore contain an incorrect lesson. And that lesson matters because investing is not merely about being rewarded once. It is about learning the right thing from what happened. This is where one of the most dangerous psychological effects appears: outcome bias. We tend to judge a decision by its result rather than by the quality of the reasoning available when the decision was made. If the stock rises, confidence grows. If it rises dramatically, confidence can become conviction. And conviction can quietly become overconfidence. The investor stops asking whether the original assumptions remain valid and starts treating the rising price itself as evidence that the assumptions must have been correct. But price is information, not a certificate of correctness. A rising price can tell you that the market is currently willing to pay more. It cannot, by itself, tell you whether the underlying business is becoming more valuable, whether expectations have become excessive, or whether the next stage of the story has become more difficult than the first. That distinction separates a stock that is winning from an investment thesis that is actually becoming stronger. There is another hidden problem. A winning position can conceal concentration risk. Suppose several holdings are profitable because they are exposed to the same economic force. They may appear diversified because their names are different, their industries sound different, or their price charts move independently for a period. But underneath the surface, they may depend on the same interest rate environment, consumer demand, commodity cycle, currency movement, or investor sentiment. What looks like several independent wins may actually be one large bet wearing several different faces. This is why portfolio thinking is deeper than stock picking. The question is not simply, which stocks are winning? It is also, why are they winning, and what happens if the common force behind those wins disappears? Now consider an even subtler trap, the cost of opportunity. A stock can generate a positive return and still represent a costly decision if the capital remained trapped in an asset whose future opportunity became weaker while better opportunities emerged elsewhere. That does not mean every underperforming alternative should have been chosen. It means that a gain should always be evaluated against the opportunity set that existed, the risk taken to achieve it, and the time during which capital was committed. In ordinary life, we understand this intuitively. If someone spends an entire day earning a small amount while giving up an opportunity that could have produced much more value, the small payment is still income. But it does not tell the whole economic story. Investing has the same problem. A positive number can hide an inefficient allocation of time, capital, attention, and risk. Then comes the most deceptive form of success, the win that teaches you the wrong strategy. Imagine someone repeatedly buys highly volatile stocks before major events and happens to make money several times. The profits create a pattern. The pattern creates confidence. Confidence creates larger positions. Eventually, one unfavorable event exposes the fact that the earlier profits were not proof of a durable edge. They were compensation for risks that had not yet produced a visible loss. This is why survivorship matters. We naturally remember the winners because winners remain visible. The failed decisions disappear from attention, while the successful ones become stories. Over time, the investor may build a personal mythology around being good at picking stocks, when the evidence was never tested across enough different conditions. The market does not only test whether you can find winners. It tests whether you can survive being wrong. And survival introduces another concept that is often underestimated: drawdown. A portfolio can eventually recover from a decline, but the mathematical burden of recovery increases as losses become larger. That is why risk is not simply the possibility of losing money. Risk also includes the possibility that a loss changes your future decision making, forcing you to sell at the worst psychological moment, reduce flexibility, abandon a sound process, or become excessively cautious afterward. In that sense, the real cost of a mistake may extend far beyond the original transaction. This is where the discipline associated with Hanuman becomes surprisingly relevant, not as decoration, but as a framework for self-mastery. Hanuman represents strength without vanity, action without ego, and devotion without becoming intoxicated by personal glory. Applied to investing, that mindset suggests something powerful: do not let a profitable outcome make your ego larger than your evidence. A disciplined investor can say, I was profitable, but I still need to understand why. That sentence sounds modest. Financially, it can be enormously important. Because the deepest mistake in the stock market is not always buying the wrong stock. Sometimes it is learning the wrong lesson from the right result. A winning stock can therefore hide a costly mistake when the profit disguises excessive concentration, weak assumptions, unmanaged risk, poor opportunity cost, emotional overconfidence, or a strategy that has simply not been tested by a different market environment. The price may be green, the account may be larger, and the decision may still deserve another examination. So perhaps the most useful habit is to separate three things that the human mind naturally combines: the decision, the outcome, and the lesson. The decision asks, what did I know then? The outcome asks, what happened afterward? And the lesson asks, what can I reasonably conclude from the difference? Keep those questions separate, and a winning trade becomes more than a source of profit. It becomes evidence. Lose that separation, and profit can become something far more dangerous: confirmation. The market will always give you outcomes. It will sometimes give you spectacularly flattering ones. But wisdom begins when you refuse to confuse being rewarded with being proven right. In investing, as in life, the strongest discipline may not be the ability to celebrate a win. It may be the humility to investigate it. Jai Hanuman.